appreciate the time that everybody's going to spend today. Just to give you an overview of what we wanted to do was expect to be about 20 minutes, maybe 30, and we'll talk a little bit about what people are doing these days to take market volatility or at least reduce market volatility out of their portfolios. There's a lot of really interesting things that are just starting to be launched out there that are being accessed by a lot of new people. Biltmore actually had their most explosive growth month last month in October as far as new clients, and I think part of that is driven by some new thinking and new ways to think about investing for retirement without necessarily sacrificing yield and return. So with that, let's just jump into this a little bit. For some of you that are joining, this might be a little bit more rudimentary, but I think it's, for most people, it'll be very informative. I want to start just to talk a little bit about the stock market in general. When you talk to a lot of people in our business, they talk about how the stock market normally goes up by 10% a year. And when I went through, in the beginning of my career, some of the coursework for being a quote-unquote financial advisor, again, you would use these algorithms and computations that would rely on stock going up at about 8 to 10% a year and bonds going up at about 4 to 5% a year. Well, midway through the decade, you realize that necessarily wasn't working very well. And when you, time after time, were talking to clients about not reaching their goals because they were so heavily reliant on the market, we thought that there must be a new way or a different way to go about achieving these goals. And again, looking at this chart, you can see that it starts in the late 1800s. A lot of advisors, when you say, well, let me see a history of the market, they'll show you, and this is what we did at my previous firm, they show you returns of post-World War II. And the reason for that is that they say that, well, we're a different country, we're a service-driven country, et cetera, and that you can't really look at pre-World War II numbers because we were just a different type of country. But I think it's very important to look at that. And if you look back here, you can see the mouse on my screen back to before 1910, and you follow that through to the early 20s. There's about 18 years there that the market was flat. It was actually negative 4%. If you were the lucky cat that invested at the peak of the market in 1929, it took about 25 years for that investment to come back. More recently, the late 60s to the early 80s, again, a flat for about 17 years. And of course, we're all sitting here remembering and knowing that over the last 11 years or so, markets really haven't done anything, and especially if you factor in all the fees that you pay advisors and et cetera, a lot of you might be negative here after 11 years. So if you add all these up, 11 years, 17 years, 25, 18, these times where the market's been flat, it's about 70 years, which is really a majority of the time the markets are trading flat. Yet, for some reason, modern financial planning dictates that you should have a majority in stock for the long haul. And, again, for us, it just doesn't make a whole lot of sense. Sure, in markets like the late 80s and early 90s, it makes sense to have a lot in stock, but there is always going to be these times where the market goes sideways. And the question that we ask clients is it really the right thing to do to have such a large allocation in stock? Especially, look at today. We sit here for 10 years, the market's been flat, and are we really in such a great position right now? Is our country in this great shape where we're going to expect a 10-year bull market? We sit here at Biltmore and don't think so. I think we're going to be flat here for another 5 years if we're lucky. So in the next few pages, we're going to talk about different sorts of strategies and different ways to think about investing over time. So in the early part of my career, I looked at what other people were doing And if you look at traditional portfolios and institutional portfolios, there's a big difference. And the big difference here is that traditional investors, when you go to a financial advisor and they talk about an allocation, they'll talk about some kind of allocation of stock, bonds, and cash, and that's that pie chart on the left. This is traditionally what people learn about when they go into modern financial planning, et cetera. But it was very surprising to me that institutional portfolios, these are pensions, endowments, very large pools of capital that typically have access to any types of strategy that they can, because they have the large minimums to access really any talent in the world. And there was some fundamental differences. I mean, first of all, as we know, individual investors are a lot more driven by fear and greed, and there's a lot more emotional decisions that go into their planning, whereas institutions typically try to take that out and be a lot more methodical about what they're doing. But one of the biggest things, if you look here on the right, is that they typically have a very large amount of alternative strategies and alternative assets. And it's our theory that this is one of the reasons why they do so much better than traditional portfolios over time, and a lot of retail and high net worth investors, because of this allocation to alternative strategies and alternative assets. And we'll talk a little bit now. There's been, just literally over the last year, there's been some recent changes to our industry, which allows really anybody out there to access the same types of tools that institutions have been doing, really for much lower minimums in almost anybody's portfolio. So we'll talk about that. So first of all, let's talk about these asset classes. Really on the left, this is what most people think about when they think about investing. It's some kind of stocks and some types of bonds. And when they talk about quote-unquote diversifying, they say, oh, well, we need some kind of domestic stocks and international and large one and small ones and medium-sized one. And, oh, we need value and growth. And in bonds, obviously, there's lots of different kinds of bonds. But we all know in 2008, it didn't matter if you had large, small, mid-cap, value, or growth stocks. Correlation sort of all went to one, and everything went down. It's just a matter of how bad you were smushed. So that's traditional investing. In our opinion, with a stock, you're sort of waiting for the wind to blow in the right direction, and a lot of people don't have control over what the market is going to do from day to day. Now, alternative investments, a little bit different, and that's what we're going to spend some time talking about, really demystifying what some of these are, how they can work into a portfolio, and some of the benefits of adding them. Some of these are REITs, and there are some time that REITs, real estate investment trust, there are obviously good times and bad times to be in some of these as well, and we're going to talk about performance a little bit later. REITs typically give out a 5 to 8% dividend, and again, they do correlate somewhat to the market, but they are a little bit less correlated than other market-based investments. Things like master limited partnerships, MLPs, these are companies that transport different types of energies, from natural gas to oil. They give between 8 and 12% dividends, and we're probably going to continue to need to transport oil and gas around this country for many, many years. So again, these are examples of alternative assets. Different kinds of commodities is another good example. But I also want to focus today, and almost more importantly, on these alternative strategies, long, short, global, macro, and managed futures, and try to take some time to demystify really what these are and how institutions are using these in portfolios. I want to talk about the managed futures market for a minute. And again, a lot of you might be sitting there saying, oh, managed futures, sounds crazy. There's these, I hear about it on CNBC, but again, it's a little bit out there. So I just want to spend about 2 minutes to talk about the history of the market and how it's changed and really what it is today. Back back a while ago in the mid part of the century, farmers were, and they still are, selling a lot of wheat to various institutions. So we'll use an example of Kellogg's, for example, and a farmer out there. Well, back in the mid part of the century, Kellogg's, who make cereal and other types of products, obviously had a huge demand for grain. And their cost of grain, their cost of capital would go up and down dramatically based on the crop of that year. So, I mean, it was a heck of a time that the CFO had to try to factor earnings, because, again, when you had your huge cost and a main cost going up and down from year to year, it was almost impossible. And on the other side of the equation, you had the farmer that was living feast to famine, depending on how his crop yielded. So at one point, they got together, and in the early part of the century, and they said, okay, let's agree on a price in the future for a price per bushel of wheat, and I'm happy with the price being the farmer. The Kellogg's was happy, and they set that price to be delivered sometime next year. And it sort of smoothed out the prices for everybody, because they knew, the farmer knew what he was going to get, Kellogg's knew what they were going to be paying, and everybody was happy. And those markets started spurting up for a lot of different things. You might remember the movie Trading Places with Eddie Murphy, where they were actually cornered the frozen orange juice market. And so over time, that market really evolved, and currencies, or excuse me, futures trade on all sorts of different commodities and interest rates and different types of equity markets, currencies, etc. And speculators have gotten involved in this market. They started to realize that, hey, again, years and years and years ago, if a hurricane was coming towards Florida, that probably meant that it was going to do damage to the orange crop, and sometime down the road, the price of orange juice would skyrocket. And so, hey, it might be important to look to buy frozen orange juice. And so, again, this is somewhat rudimentary for some of the people on the phone today, but we're trying to just tell you a little bit about how some of these markets evolved over time. So that's the futures market. Now, managed futures, what we're talking about are professional traders and that are looking to buy and sell these things based on different systems that they see work over time. So gold was a good example. As you know, gold was in a bull market for quite some time, so a lot of these traders had futures contracts on gold. Corn, a lot of people made a lot of money on corn, and meats. If you actually looked at the Wall Street Journal today, you saw that meats continue to be in a bull market. And those are the types of things that managed futures traders trade, as well as global macro managers. These managers are also trading futures, but in more of a discretionary manner. You might remember, John Paulson. He's not doing so well today, but he forecasted in 2007 that the housing market was going to fall apart. He bet against that market and did very well that year. So, again, managed futures, very interesting asset class, and we think it's very valuable to have inside of portfolios. So we're just going to spend a couple more minutes to talk about some of the benefits here. Again, a lot of your advisors might talk about diversification, and the reason for that is they try to find things that aren't correlated, right? They want to find something that when the market zigs, that it goes down, typically you want something that will zag and offset some of the downside of the stock market. And the problem when you do that inside of stocks is that when things go south, typically they all go south at once, right? In 2008, value didn't go up when growth went down. As we talked about before, they all went down. It was just a matter of how badly. Well, managed futures are actually negatively correlated to the stock market. As you can see on this page, negative 0.23, meaning that the performance of managed futures has nothing to do with the performance of the stock market generally over time. And that's why we think it's such an important asset class to appear within diversified portfolios. This brings that point home a little bit more. What we did was we had our analysts go and chart, various terrible times in the stock market. Again, the 2008 stock market crash, where it was down about 38%. And what we show is what the managed futures index did. And the Barclays CTA index, if you think about the S&P 500 as a index of stocks, the Barclays CTA index is basically the index of managed futures. So again, in 2008, the index was up about 14. When the tech bubble burst in 2000 or 2002, when the market was down about 53%, futures were actually up 23. Long-term capital management, et cetera, et cetera. Not to belabor the point, but again, getting back in simpleton terms of finding things that can zig when others zag, we think is very important. This is a chart of, again, managed futures being the light blue line, the orange line being the S&P 500, and the green line being the world index as measured by the MSCI. This is in the stock market, international stocks. You can see that managed futures drastically outperformed, and you can see this line that in 2008, when the market really came down here, if you can look at my arrow, in 2008, managed futures actually did well. Yet in 2009, when the market really came back, futures kind of plateaued off. So again, there are times when the market can do very well when futures don't do as hot, but that's why we have a mix of lots of different things within these type of portfolios. So just want to turn to long-short funds in a minute, for a minute here. For those of you who aren't familiar with shorting or might think that, again, it's a little out there or esoteric, we say, well, we think it's very important to have things that can look to profit when the market goes down. So again, typically when most people, when they invest in the market, whether it's through a mutual fund or just buying stocks, let's just take a mutual fund investor for a minute. The manager that's managing that mutual fund, typically by mandate, has to stay invested at all times. Mostly, I believe the average, it's about 90% that these managers have to stay invested within stocks. So even if they knew and they had a crystal ball and they knew the market was falling tomorrow, there's really nothing they could do besides, go to 90% stock instead of 95 and maybe buy stocks that they thought wouldn't fall as much. So again, they are somewhat pigeonholed in times like 2008 and early 2009 and 2000 or 2002 when you get into a 3-year bear market. Managers that have the ability to short are different. They can take, again, just to be simplistic for a minute, they can look like a traditional manager, look for companies that are doing very, very well and have good management, maybe good products, and look to buy those. And they can take a piece of the portfolio and look for companies that are terrible. Maybe a Netflix would have been a great example that a couple of weeks ago crashed pretty heavily, or detecting some type of fraud that might be going on. For example, like an MF Global, you see that in the news recently. And they might look to short those companies. So either way the market goes, they like to have the ability to make some money. And to us, it just makes a lot of sense to have the ability to go short, especially in these type of markets that are up and down and up and down. Why pigeonhole your strategy to only being successful if the market goes up? And when there are strategies out there that can prevent downside and do some hedging when the market falls. So again, we just think that makes a lot of sense. And there's a place in a portfolio for managers that can short markets as well as buy into them. Everybody talks about the lost decade, and as we go to this next slide, I just think it's interesting, and here's where we talk a little bit about performance with some more general indexes. What we do is, again, we look at annual returns from 2000 or 2010, again, the quote-unquote lost decade, where nobody's made any money. Well, it's right that most retail and high net worth investors, a lot of them haven't made money because they've invested mostly in the market. If we just look at the Dow Jones being the red, you can see in 2000 it's down, and I'm just looking at the line here, about 6-7%. In 2001, about 8%. In 2002, about 18%, and the S&P was actually down to much more than that. rallied back and had a couple okay years, and then again down in 2008. So net, most people haven't made any money. Well, the orange being the Barclays CTA index. Again, this is managed futures. Here we've had a lot of years where it's been, pretty mostly up, and there should be a year in here where it was down. 2009 here, again about flat. And this is just the index. Managed futures, typically we can find managers that are doing much better than the index, but again, we're just trying to, in general terms, show you how some of these other asset classes and other strategies have fared over time. The light blue being a macro index. Again, you can see that these managers have, in the light blue, have done a lot better. And in 2008, they suffered a little bit, but certainly not as bad as the red line being the Dow Jones. And moving on, we look at long-short equity. Again, these are the managers that can both short markets as well as buy into them. We can see that, they were down a little bit in 2002. I think most stock investors would have been happy if their portfolio was only down a couple percent. Fast forward to 2008, it was hard to hide for these managers. It was down. The index was down about 20 in a market that was down about 30-something%. So again, having the ability to short gave them the ability to make some money when it was down. And then obviously bonds, being the purple, have done extremely well over that period of time. So these types of strategies, if integrated right, have really rewarded investors over time, over the last 10 years, while they've seen a lot of volatility within the stock market investments. So we ask, why now? Why are a lot of people just hearing about it? Again, as I said, we've actually added a lot of some new people here, new infrastructure here to build more capital advisors, expanding out some of the offices. What we're finding is that people just don't know about this stuff, and there's a couple of reasons why. The first one is, in the past, to access a lot of these types of strategies, you had to be an accredited investor. And for those of you who don't know what that means, is that in a lot of cases you had to have a net worth of $5 million, which isn't a problem for some of you on the phone, but for some of you, that's a big number. And so there was basically a lot of problems accessing this. There was a net worth requirement. Typically, minimums were at least $100,000 a piece, if not $1 million a piece. And so, in order to be properly diversified, it was very difficult for people who didn't have lots and lots of money in investable assets. And the SEC just literally the early part of 2010 put a blessing on a structure that allows some of these things to actually start trading on the mutual fund side. So this was pretty big. To us, it was revolutionary, because what it does is, in the past, people really haven't had a lot of choices. They've had different kinds of stocks and bonds, but just recently, they now have the ability to buy into very experienced managed futures managers, different kinds of global macro managers, managers that have the ability to buy and short stock. And what Biltmore did, again, our minimums were substantially higher in the past because we used to go to these managers directly, and we still do for many clients. But what we found was that now, after doing a lot of due diligence on these various types of mutual funds, is we can actually build a portfolio that looks and feels just like some of the institutional portfolios that the pensions and endowments use. But we can do this with much lower minimums. And there's also some other benefits of daily liquidity, whereas some of these funds in the past had monthly and quarterly liquidity. So this is really exciting, and this is why many of you haven't heard about this. It is fairly new. Biltmore Capital has spent over a year building this mutual fund platform where we can access a lot of these different strategies, and again, we're really excited about it. And if any of you, this is just a side note, we spoke about it on Fox, on a Fox Business News interview last month. So if any of you would like to get a copy of that, feel free to email Ivy or give us a call, and we'd be happy to send you that clip. So a lot of you have seen this next page. Again, this is the old periodic table. It reminds me of when you're in early high school and you're trying to remember all the the periodic table of elements. But this is more into the financial space, and a lot of you seeing this with large cap and small cap and various types of stocks. Well, this is interesting because it shows some of these other alternative asset classes. What you're looking at, if you look all the way on the left, is this is year 2001, and we should label this, but in any case, 2001, 2002, 2003, 4, all the way to 2010. The black represents the division between positive performance and negative performance, and it shows some of the best performing indexes on the top and then the worst on the bottom. So as you know, in 2000, 2001, and 2002, everybody said, oh, we're not doing it well, we're losing money, et cetera, et cetera. But if you look at these, there was a lot of asset classes that were actually doing very well. REITs were up in 2001 and 2002, 14 and 4% respectively. Bonds were killing it. They did amazing. Different types of currency strategies were up and then down. Different kinds of hedge funds, and I know that's such a bad word to a lot of retail investors because of Bernie Madoff and some other blow-ups that the media loves to publish. But the fact is that the word hedge fund by its name was there, so and got its name because they had the ability to hedge and protect downside by doing things properly. And now that these things are regulated through mutual funds, I think investors can feel a lot better with what they're buying into. Managed futures, we can see we're up 4% in 2001 when the market was down about 12, and again we're up 12% in 2002 when the market was down 22. So let's fast forward to 2008. Again, the market was down about 37. Well, managed futures were up about 18. Again, some other strategies were doing very well, and even long short, it was down 19. It was a lot better than being down 37. So 2008 was certainly a tougher year. There weren't as many things that did well. But as you can see on this chart, by not relying on stocks, in our opinion, it's just so important. Looking out over the next few years, how can somebody say that we're going to be in the next bull market? I mean, it's a scary time out there. We think that it's very scary, and we think that we need to at least have the ability to hedge and protect downside and have a manager that can quickly turn on a dime and do something if the bottom falls out. And we know, we've experienced how quickly things can happen. The other thing that we do here at Built More Capital is, we want to put money in all these different asset classes, and it's just a matter of how much we weight in each one. That again, everybody's obviously different, and we will talk about this a little bit later, but we want to understand what they're looking to do and what their goals are, et cetera, and what the risk is. And we want to proactively manage this because we know by human nature that typically, let's just look here at commodities for a minute. Here, and if you look at my mouse in 2002, commodities up 31%. 2002, they're up 23, 16, 21. Again, you've had 4 years in a row where commodities did well. Well, a lot of people at that point, it drives itself. Valuations start getting out of control, and everybody starts looking in the recent Money magazine and seeing what the best performing asset class is, or what the next best performing mutual fund is, and guess what? It's commodities. Well, they buy into it too, and they push the value up and up. Well, guess what happens? It falls down the next year and becomes one of the worst performers. So if there's anything that we see here, if there's any trend, it's typically that some of the best performers end up becoming the worst, and the worst becoming the best. So at Biltmore, we want to be very methodical. Everybody talks about looking to buy low and sell high, but what happens is, they end up not really having any kind of discipline about it, and waiting and then panicking and selling at the wrong time when things are down, and then when things start getting better, they buy in again, and that happens to be the wrong time. And so they ended up buying high and selling low. But what we want to do is we want to come up with something where we do the opposite. So at the end of every year, take 2008 for example, at the end of 2008, what we want to do is sell the things that are up and buy into the things that aren't doing so hot. So we would have sold a lot of the managed futures, sold some of the bonds. And who the heck wanted to buy into the stock market in December, January 2008? Nobody, right? I mean, it felt like the world was falling apart. But look at the next year. Futures were down 2%. Bonds were one of the lowest asset classes, performing asset classes here in 2009. And equities were up 26%. So by rebalancing, basically, if an asset class really runs up, we want to go ahead and take profits, and we want to redistribute those profits into some of the asset classes that are out of favor and down. And effectively, what we're trying to do is promote an atmosphere where we're selling high and buying low, but also getting a lot of diversification, being in all these asset classes that aren't as tied to the stock market. I'm just going to spend a second on this. It just talks about the importance of rebalancing. Again, the dark red line is a portfolio of growth and value stocks, just using an example of $100,000. And they just, as they say in Vegas, let it ride. 50,000 in growth, 50,000 in value. And you see in the late 90s, growth really ran up, but you never took profits. And again, you had the internet bubble and a lot of other growth stocks. Well, bubble burst and everything sort of went down. So again, 100,000 ended up growing to 520, but you had a lot of volatility. Whereas at the end of every year, rebalancing, meaning selling the winners, the winning asset classes, and buying into the undervalued one, you can see it was a lot smoother, and you actually did better at the end. So we think it's very important, and most investors don't adhere to that rule. So just to give you a feel for how some of this has transpired, and really this is just some of the indexes. So but we wanted to give you a feel for over the last 10 years what these types of strategies have done. So this is looking at the moderate aggressive model here at Biltmore Capital. And again, these are indexes. And mind you that at Biltmore, one of the things that we're looking to do is find managers that can outperform the indices. So if we're buying the stock market, instead of buying the S&P 500, our due diligence team is looking for managers that have a consistency of outperforming the stock market. And we do the same thing with managed futures and other things. So this is a 60-40 mix of stock and bonds. Again, it is annualized after fees, about 6.5%. You can see that in 2000 and 2002, it never experienced a negative year. In 2008, it was down about 14%. So I think a lot of people out there would have been okay with 14%. And it's recently, obviously, come back much more since then. And this was through the end of September. October was a great month for the strategy in general. So again, you can see that if you compare this to the S&P on the bottom, here's the S&P 500. Again, my mouse is on it. We go down, we go up, we go down, we go up. We're almost at the same value. So again, by rebalancing and by being in, if you follow my mouse here, managed futures, commodities, REITs, master limited partnerships, long-short strategies, global macro, but also having pieces in different parts of the market as well, emerging markets, global, et cetera, but being methodical about selling the parts that are up and buying the ones that are down, again, we think are a very important part. Again, in this market, we're in very, this is the new normal, as Bill Gross would say at PIMCO, and I think he's right, and I think that we have to get involved in a lot more nimble strategies and strategies that are tradable, and managers and strategies that can go quickly short as well as buy into whether it's metals, currencies, commodities, et cetera. And we just can't rely on buying and holding the stock market, especially if you look at how bad our situation is in whether it's the U.S. or Europe, et cetera. It's not good news, and it's not going to be getting any better anytime soon. the Fed spoke yesterday, and he told us that. So just to talk a little bit about Biltmore in a 2-second or 2-minute commercial here. While we certainly enjoy the asset management side, everything that we do is mostly driven with a financial planning approach, where we spend a lot of time in the beginning during the discovery process understanding what the client's looking to do. The fact is, everybody's different, and how do you put together any type of strategy without really understanding what those goals are, and often during the discovery process we find issues that they don't even know they have. There was somebody that had some rental properties, and they never had them in an LLC, and I'm glad we ended up finding that and recommending doing that, because if you can imagine, I don't even know how somebody does this, but somebody actually hung themselves hanging their Christmas lights. As you can imagine, if that property wasn't in an LLC, they would have been in a lot of problems. Other things that we find are, people have boats and toys and jet skis and things that, again, they're just not properly insured. So, we spend a lot of time doing that. We come back with what we call our solutions analysis, and this covers everything from estate planning to different insurance needs to, problems that we see within portfolios and hidden fees and other things that we might find. And at that point, people either say, okay, let's work together, or let's not work together. And assuming people come aboard, we move on to the private banking experience, where we try to get all their cash flow needs together and setting them up with any credit lines that they need here. People can borrow against these portfolios at about 0.85%, so we might look to pay off mortgages or home equity lines or other things, taking advantage of those rates. The private client vault is again, a very valuable part of the process. We typically get to know our clients very well, their families, et cetera. We like to be there through good times and bad times, and we typically will upload things like wills and trusts and other very important insurance documents and other pieces of information into a secure online vault. So God forbid if somebody does pass away, we have all these documents together and can help our client's spouse through that difficult time in their life. Personal risk analysis, we typically will collect insurance policies, whether it's auto, umbrella, many other types of policies, and we work with third-party advisors to both look to shop them out and reduce the rates, but also, more importantly, try to understand if there's any gaps that need to be filled. And we can certainly, at Biltmore Capital, help to grow assets over time, and I think we do a great job of doing that. But I think a lot of people out there don't take the time to make sure they're protected. And you never know. You could drive home one day and hit somebody, and they could sue you, and it could all go away. So we want to make sure that we've done whatever we can to make sure that they're bulletproofed, and at least we know that the risks that they have. Then finally, strategy snapshot. Regular reviews are important to make sure that if there's any constant, it's that we all change, our life changes, our circumstances change. As the T-shirt says, SHIT happens, and we want to make sure that we have everything in place to address that and make sure that we're doing things to take care of our clients. With that, that concludes the webcast. I hope you found this somewhat informative. And if you have any questions, I think what you can do if you're on the webcast is ask a question online. And this is fairly new for us, but I hope we have the ability to see that you're asking a question and answer that question. So again, if you have any questions now, just if you would go online and raise your hand, we'll go ahead and pick you and go from there. And while I'm waiting for that, I'll just say that if anybody is interested in hearing a little bit more about what we're doing and how that might affect your personal situation, feel free to give a call in and ask for for Ivy or myself, and we can go ahead and schedule a meeting or conference call and talk a little bit more about how some of these things might fit into your overall plan. So either the technology doesn't work or we've done a great job